All right, what's going on, everybody? It's another week, another Ask Me Anything. Sometimes Wednesdays kind of feel like a marathon, but this has been a good one. WTF was amazing. Wealth webinar was super fun, and now we're here to answer your questions while we actually share a Modelo Mango Chili. Interesting, but we'll be right back to tell you about the Modelo Mango Chili in just a moment. All right, we are back. It is another week of Ask Me Anything happy hour, and today we've got all sorts of things to talk about. Most importantly, we are doing a testing of Modelo's Mango Chili. So here goes.
No, those are pretty good.
You know that's also Anheuser-Busch, just saying.
No, it's not.
Yes, it is.
What?
You're welcome. So over here, we're having Celsius in Florida because it's not by Anheuser-Busch. And
Tricky. I just bought 12 of these stupid things, and now you're going to go and tell me something crappy like that? Tricky. It's kind of like those IUL guys, you know, they're tricky too. But anyway, what questions do we have in the lineup?
I've got one from Mike, who's actually on. He commented, so I'll get to Mike's first. He says he hears Chris and others say that they lend to their LLC money. I told my tax guy that I wanted to do this so that I could take advantage of the tax savings on interest paid from my LLC to me, while the LLC lends the money out to others and pays the LLC interest. However, my tax guy keeps telling me, and he's asked him several times, that doing this is just extra steps that just doesn't give you the benefit of writing off the interest in the business, because when the LLC pays me back the interest, that interest on a personal level is taxed as income, and it turns out to be a wash. What am I missing?
Not missing anything. His accountant's giving him the exact way it is. The interest, that's paid from the company, from the entity, is a tax deduction to the company. And then when it's paid to you personally, it's taxable to you. And I had this discussion with him, so most people would just stop right there. But then when you really start to look at it, there's a lot of things that aren't being factored in there. I mean, you could literally have the interest just paid to another account that you set up within the company. If you're the only owner of the company, instead of paying the interest directly back to you, keep it in the company, figure out what your distributions, your allowable distributions are, and then distribute, whatever funds up to, the point where it's going to become taxable. So there's all sorts of ways to do it. But his accountant did give him some interesting advice, which I told him, I said, this is not a bad idea, is, take the money from the policy and make a capital contribution to your company. And then that company can use the capital contribution, and then you can take the money back out because it was a capital contribution put in by you. You could take that money back out, and you could find ways to do it that way. So there's multiple ways to do it. But at the end of the day, a CPA is always going to play the, tax deductible versus taxed. It's not about that. It's still about your business is going to pay somebody interest in principal. Okay, if you need money for your business is going to pay interest in principal to somebody. Is it going to be Bank of America? Is it going to be Ally Bank? Who's it going to be? I think it should be you. So if it's you, even if you got to pay tax on it, you're still ahead because all the money comes back to your account. You control the money. And not only that, the money never stopped earning interest, but I feel like a broken record every time I talk about uninterrupted compound interest. So those are my take on it. Anyone want to take a stab at that?
I was too busy taking notes. So you can be a broken record. Hannah's got her eyes closed or she's frozen, one or the other. What do you guys think?
I was wondering that.
Look at my makeup job today.
Oh,
Yeah,
nice. Deep thought.
And just for the record, it does not say anything about Budweiser on here. It says brewed in Mexico. Since when is Budweiser a Mexico company?
They are. So if you look them up, they own like 10 of the top beers. Because I looked this up after the whole thing that I've not really fully comprehended because I didn't take the energy to do so. But I like Modelo. Modelo is owned by Anheuser-Busch. I like Stella. Stella is owned by Anheuser-Busch.
Can you
And I went
do a
down.
report and send me every company that's owned by them so I can just make sure they don't make it in the fridge?
Yeah, I'll do it right. I'll do it right now while someone else is chiming in about things I'm learning about.
All right, perfect.
I was just going to say, so how my family does it over here is we incorporate the 1041 tax structure. So what we'll do is we lend actually from a specific business trust. Business trust goes out, makes the lending deal. All the profits come back to the business trust. And then that's how we are minimizing that tax liability. And actually, shout out to Suleiman and Mahi because they had a really cool webinar last night. It was at 5:30 Eastern time. And I bet they have the recordings, or if you want to reach out to them, just send me an email. But they went through all the 1041 tax structure. But that's how my family's doing it over here by minimizing that liability.
Same here. Same with
Here
Joe.
too.
I didn't know, but that was interesting. You just mentioned that he'll allow us to share the recordings because he never has in the past. So if he sends you the recordings, can you send them over to me? I definitely have people that I'd like to send that to.
Yeah, I don't know if he's going to send out the recordings. I think you can ask for it though, but I'll find out.
Okay. I should have had a couple of people on there last night. I'm hoping.
I think I did.
Trying to teach some folks about this stuff. All right. What do we got?
Okay. Let's see. We've got Corey says, what are the best mutual companies to open an infinite banking policy with?
The ones we use.
Oops, sorry.
Next.
Good job.
Actually, can we talk about that real quick? Because I
think
know
we
you
should.
guys also get this question a lot too. I'll get done off a stage, or maybe I get done with a podcast and people reach out to me and they'll say, Hannah, this stuff is really, really cool. Who do I go to open up one of these policies? So what can y'all explain what the money multiplier does? And let's get into the question. What are the companies that we do work with?
So the Money Multiplier is a landscaping company that sells trees that grow money.
Oh, you brought it around. I liked it.
I like that a lot.
They're magic trees, and you could only get them by actually getting on the phone with one of us.
Person likes it too.
Joe,
He's
Joe
laughing.
wants it.
Can't even
Look at
see.
Joe.
Oh, I'm sorry, Hannah. What is the Money Multiplier?
So what we do over here is that because I know we always lead with the education first, and so some folks will get done and they're like, okay, this is something I want to do. Who do I call? So pick me over here. And Gabby, Shauna, y'all should post something in the comments of how they can get connected with us. But what we do, I mean, we help folks every single day. We design the policy properly for this concept based on your needs and goals, because everybody's different, right? I mean, I could be talking to somebody who's 15 years old. They're not too concerned with the liquidity right now. They're looking for 10 years down the road. They want to go buy a car versus my 67-year-old who's in the retirement stages right now. So everybody's different, and these policies can be designed any which way. So anywho, so that's what we help with, designing that policy, helping you obtain the policy. And then I personally just always say our work doesn't begin until that policy goes active, because just like how Nelson Nash teaches us, it's not the product, it's the process. And so that's when our mapping team will step in and really help you use and implement it. But to answer the question too, the companies I personally recommend, the companies I'm buying my policies with right now, One America, based out of Indianapolis. Security Mutual Life of New York is another great company. But then, you also got others out there like Lafayette Life, Guardian, Penn Mutual. They're all great companies too.
That about sums it up. I like it.
Yep. My favorite.
Okay.
thing.
I do have Shauna reminded me there's a couple pre-submitted, so we'll come back to these ones. So I have one from Arnaldo. He says, let me get to it. He just got denied by Lafayette for not going to the doctor for the last 3 years, but he's healthy. He had perfect lab work from his IUL he had about 2 years ago, and perfect lab work and a perfect EKG that he did for Lafayette. So his first question is, can we request a reevaluation if he goes to his doctor, or can he apply to a new insurance company? Start there.
Yes to both. You could do either or. I would say the only reason, I doubt that you got denied. I bet they may have just postponed you. And the only reason that they would postpone you is inside of your records. Let's maybe say that your doc recommended you to go do a study or a test or something like that that hasn't been completed yet. And so they just, if a professional is recommending you to do that, the insurance company wants you to go do it because, hey, it's lack of better words, what you should do. I'm not the best person to talk about this because honestly, I grew up in holistic care. I chiropractors. I got my chiropractor and my OBGYN. That's all who I go see, right? But I think that's the only reason that they postponed you. But yes to both of those answers. If you want my advice, since you already did the underwriting with Lafayette Life, and if you just need to go do a follow-up appointment, I would just go get it done and then say, hey, Lafayette Life, I got it done. What do you say? Can you approve me now?
I agree. I've seen tons of people get an initial rating, and then within 6 months to a year, like they've taken the policy with the substandard rating, and then within a year, they've then gone back to the same carrier with new medical information. Like usually it's just doctor's notes, and successfully gotten their rating marked. And I've seen them go from like a substandard rating to a preferred rating. So definitely don't ever think, oh, I got a bad rating, I shouldn't do this. No, definitely do this, then work on the problem. Or if it's just something stupid like what this sounds like, just get your doctor to do the notes.
What? That's incredible. Is that real? Are you guys kidding? You can go back later?
Taking notes again. Just so you know, like even though Budweiser owns Modelo, this has got like a little spice. My lips are tingling.
That's the chili pepper.
The chili, yeah.
Yeah.
Mango and chili. I thought I'd hate it, and that's why I was actually joking about it. But
yeah, now you're liking it. It's enjoyable, right? It's okay. I like Modelo. It's okay to drink Modelo.
Quite yet. I'm just saying my lips are tingling.
But
a little jalapeno.
Before Gabby reads the next question, though, just think about what Chris and Hannah were just talking about, right? Like, this is the most abundant vehicle. When we're looking to add more value to the world, our language, our mindset, how we show up, how we serve. If you have, like we say, it doesn't matter what the vehicle is, show us something else that does better and we'll use it. But if this is the most abundant vehicle and it gives you more choices, if you can go back and get healthier and it forces you to get healthier so your money works harder for you, damn, that's cool. Think about that.
Okay, Arnaldo had a second part to that question. It's in regards to what happens to his old IUL policy. He did a 1035 exchange because he assumed he would be getting a new policy, so he canceled the automatic payments from that. Can he restart that IUL or get cash value back from it? He never thought they would deny him, in perfect health, never been hospitalized, take no medications. Although my wife qualifies for a policy, I'm the only one with income, so I want policy on me first, just in case anything should happen.
Yeah, I mean, two things you could do. You could definitely call them back up and tell them to just keep it rolling. So if the new policy didn't go in force, the 1035 never happened. So the money's still in the IUL, and you would just start making premium deposits. Or secondarily, you could make sure and make sure of this. Actually, I already know the answer. It's an IUL, that you don't have more money in cash value than what you put in. But like I said, I'm pretty darn sure you do not have more money in cash value than you have put in. So your cost basis is probably just fine. You could just cancel it and take the money out. But I would probably advise not to do that, because then you lose the death benefit. And God forbid something happens from now until the time when you get approved or get the medical thing situated. I mean, you always got to think that way. So I wouldn't surrender it. I would just keep it alive until you can get approved. And I think, if you started with Lafayette, I mean, let's get some preliminaries with another carrier and see if we can get you approved at a different carrier, like maybe One America or somebody else. I mean, we'll go right down the line.
Actually,
choices, Chris, that's awesome.
So the next, I'm just going to keep going because I know we're going to end up with a lot of questions. Brendan is the next pre-submitted. He's got actually a really good question. I know a lot of people ask the same question. So he said he wants to purchase a new or used truck before he builds his cash value. Since he just started his policy this month and he's paying monthly, is it reckless to buy one using the regular method through a bank loan and then just pay off the loan as he begins to build cash value into the policy over the next few years?
Not at all. I think that's a great idea. Hannah, you're shaking your head yes too, right?
Well, yeah. Okay, so actually, I picked this up from Steinhaus. I was listening in on one of his radio shows, and he had a listener call in. And high level of it, he says, there's lifestyle choices and there's financial choices. Obviously, the financial choice would be, hey, save the capital, use the policy, pay cash for the vehicle because you're the one that's going to keep all the interest, the profits, the dividends within inside of yourself. But I mean, if you got a car that's like pooping out on you and it was like dead like yesterday, hey, you may have to go get a bank loan, go buy yourself a new vehicle because you got to have transportation, and then just use the policy then to just go pay off the bank loan now. So I don't think there's any right or wrong way, but I think this is more of a lifestyle choice.
Jason, your email just ruined my day. All of these are owned by them?
Yeah, isn't that incredible? I mean, I know we're talking about IBC, but there's 10 companies that control all the food in the world. There's 5 diseases that were here 100 and some years ago that are killing everybody, and the reason why people get denied for life insurance. So, I mean, it's all connected, folks.
It's probably good because, you probably get a better rating if you don't drink any alcohol. So the fact that all of these are under that umbrella, I should just cut them all out and then, I'll still get preferred ratings.
Yeah, I actually had some Venezuelan beer the other day. It's not owned by Anheuser-Busch yet. It was decent.
Yeah.
At a Colombian restaurant. It was pretty good.
Yeah, I'm sure BlackRock owns them though.
Probably.
Sorry, I'm comic relief in between questions.
Yeah, no, it's all connected, folks. It's all connected. If you're watching the big picture, there's no conspiracy here. We're just telling you the truth, like we will continue doing regarding your banking control. And we also want you to get healthy. We want you to take care of yourselves, have a better life, have legacy, and we're going to keep telling you the truth.
Okay, Drew has kind of a follow-up question to the LLC deductible question that we asked. So he said, doesn't that make the interest that you pay back to the insurance company deductible though?
Gosh, that depends on your CPA. Most CPAs would say no. But I've seen some CPAs take the deduction.
As Joe sips on a Stella, if anybody missed that.
Hannah, what have you heard, or I wish we had a CPA on this panel. What have you heard about the interest? Because the insurance company does charge you interest on the loan. Some CPAs will say that can be written off personally, and it couldn't if you were just W-2 and you just had standard deductions. But there are ways to do it. But I don't know. What have you heard?
My guy told me yes, but I am a 1099.
And I think that might be the differentiation. Right? You'd have to check with your CPA on that. We can't give tax advice, but I've heard both sides. I've heard some argue it, and I've heard some say, of course you can.
I can throw a curveball.
Yeah, throw your curveball.
My trust owns mine. I have no interest. No write-offs.
Mm-hmm.
The other thing I've heard, and I don't know if it's true, but in order to deduct the interest, I was told that it has to be a structured loan where it has to require a payment back, where life insurance isn't that way. So I'm not sure how applicable that is, but that might be part of the equation.
Wouldn't that just be writing a promissory note from you?
That's what I was going to ask too. That's
exactly
but the insurance company doesn't write that promissory note with you.
You would have to.
It's between you and the insurance company, and they don't have any structure, right? So I think that's where the problem might come in. But I don't have a CPA letters behind my name.
Bingo.
You have a spreadsheet to figure this out. So
yeah, I want to know who the funny guy was that put our names on today.
You name it and I'll do it.
Okay, Peter.
It's gonna be Mr. Semi, because this week I'm supposed to get my first payment. So
I better change it then.
Might be the green light.
Okay. HELOC question. Oh, my computer worked. There we go. Peter says, we saw the video about using HELOCs to make investments. What are your thoughts of this technique, using the HELOC to pay off his home mortgage faster than the chunking method?
What is chunking?
Just making
that-
big chunks down on your mortgage, kind of like the chiropractor example, where the 1 year he made a big chunk down his principal, next year made a big chunk.
Okay, I didn't know if he was confusing that with velocity, but I mean that's done on a monthly basis also. So, well, of course, I mean anything that you're using the HELOC for would take out the mortgage also. So Peter, you must have a mortgage and a HELOC then. I guess that's kind of what this is. But you still should use your HELOC as a one pot system. All the money should go into the HELOC, and then your HELOC should be paying your mortgage, your gas, your electric, your credit cards. You should still be putting all the money that comes into the house into the HELOC. The HELOC still should be your savings account, your checking account, and your investment account. Everything should get paid out of that. And then any leftover in that, well, then obviously you would put that into investments to make more money to come back into the house on a monthly basis. That's the velocity part of it. Craig?
Yeah, I think that's a good explanation. I was going to say, why don't you share with the group the difference between this HELOC that Peter probably has and an all-in-one, because those are different animals.
Well, they are. However, you can still utilize this the same way.
Right.
So if you have a mortgage and you have a HELOC, that means that the bank won, and now you're paying two bills. If you do an all-in-one, that incorporates the mortgage inside of the HELOC, therefore combining, which is a consolidation loan, which is getting rid of all of the extra payments and only turning it into one.
And I think the other benefit to the all-in-one is that when you make payments to your mortgage, you can't call the bank up and say, you remember that $1,000 I gave you last month? Can I have it back? So they won't allow you to do that. But if you have the all-in-one type of a HELOC structure, if you put $1,000 into that mortgage payment, you can always pull it back out to do something with it. So it just gives you more flexibility for how you want to use your money and control it. So we always talk about, we want control of our money.
This is true. And then if you did have this process with a mortgage and a HELOC, and you had leftover equity, we'll call it, and you put that into an investment, and that investment makes another $1,000, that $1,000 can go directly to the mortgage principal, because that would be extra money that wouldn't be needed for monthly bills, to compare apples to apples.
Beautiful.
Good. Okay, wrap that one up with a nice bow, Joe.
You guys are like Abbott and Costello of HELOC. It's amazing. It's a show coming. It's a show
on
coming,
first?
Chris. If
Who's
you didn't
on
write
first?
that down, there's a show coming here.
What's on second? I don't know. Third base.
Okay, Brian's asking if we think we're in a recession, or is the government trying to kick the can down the road till the next election?
Both. We are technically in a recession by technical measures. I mean, maybe not today, but when we entered the recession, we definitely entered the technical definition of a recession. Secondarily, is the government trying to kick the can? Of course, it's an election year. So they're definitely going to do everything they can. I mean, the markets, in my opinion, are manipulated right now. I can't see too many reasons why the markets are holding the levels they are. It doesn't make any real sense, but that's typically what happens. I would definitely be very cautious with the markets. I would take your gains out of the market. At least that's what I've been talking about, because the markets are certainly at a high point. And yeah, high interest rates are going to not just kill small businesses, they're going to kill big businesses. And not only that, they're hurting the government too, because the government's debt, the payments on the debt have doubled. Hannah and I saw that. There was a chart done at the last event we went to, and Jason saw it as well, where they showed like how much the debt that the U.S. government, the interest on the debt the U.S. government is, and it's doubled because of interest rates. So I think you'll see interest rates head back down the other direction, but not probably until 2024, when we're deep into a recession. And I love the people that say, oh, it's going to be a soft landing, it's going to be a mild recession. There ain't no way. There's just no way. But shoot, I'll probably be proved wrong, because manipulation. What do you think, Carson?
I don't know if I'm qualified enough to answer that. I don't know. I'm here to learn from you, man.
if you all want to have some fun, go to usdebtclock.org and formulate your own opinions on what Chris is saying about the US's debt and where it's going in the next few years. And it has all kinds of things you can watch. You can just sit there and go squirrel, squirrel, squirrel for quite a while and down the deeper rabbit hole. Because I know you guys love rabbit holes or you wouldn't be here. So
I'm doing my best. I got this idea. One of our members planted this idea that I should do a mastermind at Jekyll Island, at the Jekyll Island Club, and that we should try to get the author of that book as a speaker.
Wow.
that would be cool.
Epic.
That would be epic.
Okay. G is saying, as a 50-year-old female with a mortgage, I'm so confused how to get my retirement planning started. She's got an old 401k from previous employers. Should she go the self-directed IRA route or infinite banking? I'm guessing she's wondering what to do with her 401k.
Yeah, definitely self-directed IRAs. So you don't have to pay the taxes on it. I mean, if you go to the infinite banking concept, if you do a policy with your 401k, it's going to trigger taxes. So if you're 50 years old, not just taxes, but because if it was just the taxes, I'd probably make the argument that, well, let's rip the Band-Aid off and just get the money to a non-qualified tax-free place. But the problem is you're 50. So not only are you going to pay the taxes, you're going to pay a 10% IRS penalty. And that's just a lot of drag to try to overcome just to bring it all into a tax-free, environment like the infinite banking. What you could do is technically you could set up an infinite banking policy. You could take, there's a couple different ways to do it, but you could take withdrawals from the self-directed IRA when it goes there, and then have those withdrawals then fund your infinite banking. That way you pay taxes on the money, which you're always going to, but you pay taxes systematically over a period of time, which chances are that will not bump you into a higher tax bracket, but you've got to check with your CPA for any tax advice to make sure that it does not bump you into a higher tax bracket. The goal is to get all the money out of retirement accounts and into non-qualified accounts or tax-free accounts. But in this case, do not just rip the Band-Aid off and pay the 10% IRS penalty. You can move it to a self-directed IRA with Horizon Trust, and then you can be your own bank from the IRA until you're 59 and a half. Then you can start drawing down the IRA while it's still working for you, and then fund the infinite banking with that. So it's a cool strategy, really is. I should do a video on that.
I have a question. It kind of matters how much is in the 401k though, too, right?
Yeah, that's true. I mean, if there's
also-
$5,000, rip the Band-Aid off.
I also think what plays a factor into it is the age too. Would your answer be different? Let's say instead of 50, they were 25.
Yep, it would. They got more time, but at 50 years old, it's 10 years away from not having to pay the penalty, and it's all just a mathematical calculation. You could literally just run the math. 10% of the balance is going to cost this, and then you could basically say, how long is it going to take me to make that back? Now, if you get around our campfire, which it sounds like you are, Guy, then you'd find out it wouldn't take you long to pay that IRS penalty back at all. Lend it to the Fullers, and 1 year you're whole with a 2% positive, and then whatever the insurance company paid you. So there's an argument on both sides. I always err on the side of caution and just tell people roll it, into a self-directed IRA, because for most people that's the right answer. And I don't ever feel like having a CPA go to the client that I said, rip the Band-Aid off and then start a big issue, file lawsuits, then you're in arbitration. And anyway, I'm always looking 10 steps down the way. Oh, nobody liked those words, did they?
Yeah,
Question
no.
for you, though, on
I
that
was
one.
thinking how risk adverse you are. That's the thoughts in my head. I just didn't say it out loud, which I appreciate, right? I mean, you're trying. I shared this with someone today, and they said the reason I came to you guys is because of how real Chris seems compared to most influencers and people talking about this. So just to acknowledge you from that space, right? And I said, well, yeah, that's Chris's biggest. No, that's not only his biggest strength, it's his biggest weakness. Because it is a marathon, right? And one of the things that we talked about is in this marathon, we have to love ourselves like it's like our life depends on it, right? And so while we're helping people and giving this kind of advice, it's always looking at like, well, why are we saying the things we're saying? We're saying it because there's people out there that'll take advantage when we're trying to care so much for everyone. We're just protecting ourselves, our loved ones.
I've just been doing this a long time. I've been doing it 20 years. I've seen a lot of really nasty stuff. And Carson's dad, Greg, and I talk a lot about this, and we've both been at this for quite some time. And we've both seen some really ugly things, and we've seen the ugly side of people. You know, when someone gets in their head, and it's usually an attorney or a CPA just trying to create issues or just trying to be right, I think is more what it is, the ego-driven side. And the fight, as Brent Kessler, I'll bring everybody in, would say, is not worth the squeeze. It's just not. You know, the juice is not worth the squeeze. So I always tell people, you know, I just always go back to the first part of the book of Genesis, you know, like, don't be tempted by, you know, the apple and, you know, the serpent telling you. It's just sometimes it's better not to take the money. Sometimes it's better not to take the client on. Sometimes it's better not to try to get everybody's business, because, you know, a lot of times the people, you don't want to work with them. And it becomes very evident right in the beginning when you're working with somebody that, you know, you shouldn't work with them. Your gut will tell you. And then I always tell all of you, first we figure out who our client is not, then we'll know who our client is. You know, and it's backwards. Everybody's like, oh, let's figure out who our client is. And well, then you're going to figure out who your client is not the hard way. And that is not something I feel like doing. And it's just not worth the hassle. It's not worth the money.
You know where they should go?
What? Sorry.
You know where they should go, Chris?
Forklifts, or is it semis today?
No, to their broke-ass brother-in-law.
Oh, right. Yes, of course. But the broke-ass brother-in-law is probably the one that planted the idea. Then they said, oh, just hire the attorney to file the lawsuit. And then the CPA gets involved and gets kicked out from the attorney, you know, fees. I'm just making this stuff up.
Then we'll just go forklifts and semis then.
Then we'll go forklifts and semis.
And Chris, full circle, and thank you for sharing the thoughts you just shared. Would be, you know, when, oh my God, I forgot what I was going to say. How about that? I just went blank. Must have been drinking too much Modelo at some point. I'll come back to that thought, but it was something worth sharing. So we'll come back to it.
It'll come back.
But back to the self-directed IRA, I have a quick question for you guys on it. Do you guys fund your contributions to your IRA every year through your policy?
3 years ago, I did. Oh, no, not through my policy. No.
Does your policy pay the IRA contributions?
Oh, wow. I never thought about that. Yeah.
I have one person who does.
So,
no, we wouldn't want to.
Yeah, I'm just trying to think, how would you recapture the money? So you get the tax deduction, and if you need it, you need it.
But the way that we're structured, we wouldn't. That wouldn't be going back.
Joe, no.
Well, yeah, your structure is different.
Joe, you talk about the structure a lot. I talk about it so rarely because nobody even understands it, and sometimes, you know, I'm kind of just thinking to myself, ain't nobody got time for that to explain it all. I truly like people. As soon as you talk about it, it's so cool that everybody wants to talk about it. And I'm just like, oh, I just didn't want to go down that rabbit hole. But you're right. We probably should talk about, you know, Sullivan's, or just say, hey, you really should jump on this webinar and watch this. And plus, it's just applicable to so few people.
Yeah.
I think that's,
well, it's opening up to more now because he's got 2 webinars.
Yeah, but I like that, Carson. I mean, I don't think that's a terrible idea for the right person that's doing it.
Yeah.
You're super young. I mean, if you're are you funding a Roth?
Yeah, it would be a Roth self-directed. So there's no tax benefits up front. Yeah, just to lend it on real estate. Yeah.
Dude, that makes all the sense in the world because you're using all the vehicles in the exact right way for the right things.
Yep.
Carson's going to be rich. And so, hey, this is $1 million piece of advice I got today, and I'd be remiss not sharing it with everyone here and everyone listening with the entrepreneurial minds and genius that we have here amongst us, right? So when we're thinking, Chris said, you know who your clients are not, so you know who your clients are. Actually go an extra step and not only write down who your client is, take a picture, find a picture of someone, put it up, give that person a name, give that person a description. How old are they? What do they do? What do they like? What kind of family do they have? Where do they live? All of the things that they are. And so, you know, when you're talking to them, like, this is my person, this is my client, right? Someone was telling me how to get in the mindset of someone else when writing. And I was like, that's genius. Like, literally just go put that person on your screen and make that a point of emphasis and focus. And that'll really help you hone in on who your client is not. Because we were talking about, like, before we came on live, we said to Hannah, I'm like, Hannah, you can't save everyone. Not everyone loves banking as much as we do, you know? people go out and things change, right? Things change, jobs change, their spouse gets involved, other things happen, all kinds of stuff happens during the underwriting process. And we're always like, what happened? We put all this time and effort into you and you left us. Why? And it's really, things always change. And so if we really know who those people are, the seekers of the world, the people that want to take control, then we won't be as confused and we'll all do better together. $1 million right there, recorded at 35 minutes.
Okay, let's get back to questions because we've got like 15 minutes left. Ken, I guess he has a follow-up question about like the medical test we were talking about with Arnold. He says, if you get retested, would those tests also exclude you if a new condition showed up? Could. Depends on what it is.
Does your policy change the other direction if something shows up? Like say you were standard and you said, oh, I'm preferred, I'm such in good shape. And you go back a year and you test and you come back, table rated at that point. Does your policy go in the other direction? Is there any risk to that? That's not something I've thought or asked before. No. Okay. So you can only go forward. Okay. So I think that's kind of what he's asking a little bit. So.
Well, Jason, you could test that. Why don't you start smoking, and then in about 6 months, go back and get some underwriting.
What are you trying to do? Supersize me? Remember that? You remember that movie back in the day about McDonald's? Eat McDonald's and leaving McDonald's in the car for like 12
Eat all
months.
that garbage.
And it looks exactly the same. Yeah. Thanks, Craig. Thanks.
I knew that you wouldn't. That's why I said I knew you wouldn't.
How do you know I didn't start?
I don't know.
Okay, Philip is saying, can you explain the difference between direct and indirect recognition, non-direct recognition loans and what you look for?
Gosh, y'all, I think everybody here can. Who wants to take it?
Kirsten.
Give it to me.
Go ahead.
Direct versus non-direct recognition companies. So we technically work with both recognition companies, but non-direct recognition means that when you have a policy cash value and you request a loan, you pull those funds out. The insurance company, if it's non-direct, will not directly indicate that those funds are pulled out, and you will still earn interest on everything you've deposited as premium. Direct recognition is the opposite. They directly recognize that your funds are pulled out, and they will not pay you interest on everything, only what is left in your policy minus your cash value loans. Does that make sense?
Well done. Very succinct.
Okay. Oh, this is kind of a cool comment, James. He says the last policy on my life was issued when I still had 2 moving violations on my license. The moment they fell off, I asked MassMutual to re-rate, and they did.
Of course.
So it's not just with medical.
They're all easy like that. I mean, if you just provide proof that the problem that they gave you the rating for is no longer a problem, they'll definitely remove it.
Awesome work, James. Way to contribute that to the. I saw one from Jordy Jacobs, and what's up, Jordy? He asked, like, is it something about diversifying over multiple policies? I know most people here have multiple policies. Chris, Joe, Craig, Hannah, right? So Carson. So I'd love to hear your guys' thoughts on that.
Real talk. I mean, I'll just be very blunt. If I had to choose, I would just say with all one specific company that I just personally like the best. I just enjoy their servicing and I enjoy their products. But the reason I have multiple policies with different companies is because if I'm going to be doing business with them, I got to understand from a consumer side, hey, how does this company do the business? Because again, it's not about product, it's all about process. So I want to work with the companies that understand infinite banking and me taking out my loans, paying them back, and understand what I'm doing over here. The Southern hospitality. That's what I say.
Well said. Thank you.
No right or wrong answer though here. Stay with one company or diversify.
Yeah, it's the same. Again, right? We have more choices when we make wealthy decisions. We make abundant decisions, right? You have multiple ways you can pay back the loan. You have multiple ways that you can pay your annual premiums, whether they're monthly, quarterly, right? Annually, semi-annually. So you just have more choices, which is what you want. So if you want to go with multiple, go with multiple. If you like one, like Hannah said, and you feel like they're safe, I mean, keep going with them. It's really individual choice.
And James kind of gives a little bit of CPA feedback to that one original question we had. He said that interest is deductible on Schedule A, but at a very reduced rate. However, if you put it on your Schedule C and your business is lender, then deduct it. And it needs to be structured on paper. So that's cool feedback.
Thank you, James. And you just broke my head. I don't know what you said, but it was brilliant.
There's a way. Basically, that's what he's saying. There's a way. Okay. MRC says, will it hurt my policy if I'm depositing PUA within contract guidelines to ultimately transfer third-party debt before I start paying policy loans and take advantage of the PUA rider within effect?
I'm trying to figure this question out.
I'm having a hard time with this one too. Like I think I got it, and then all of a sudden I'm like, no.
I think the question, MRC, and if it's not it, go ahead and reply. But I think they're asking if they take a loan out of their policy and don't pay the loan back, is that hurting the policy?
Oh,
Typically during the loan, when you're paying off the debts, you're throwing everything you can at the debts. And then after the debts are paid off, those third-party debts, then you want to run those same payments back into the policy on the loan side. But I don't know if
that's
someone
part
else
is where I get confused. The take advantage of the PUA rider within effect. That's the part where I'm kind of, I love some clarity. But Craig, what you said makes sense.
Part of it makes you think they don't want to repay the loan because they want to max out the PUA. But the two, I feel like, should be separate. Like if you build the policy with PUA, that's your premium deposit base in PUA. So like that's the amount you were saving before. Then you pay off a credit card with a loan from the policy. The amount that you paid off, like the amount you were given that debt, should just go back to the policy as a loan repayment. It's the bottom part of the circle. So I guess I'm kind of mixing. Yeah. I'm getting mixed between the PUA and the loan repayment. I don't think you should sacrifice the loan repayment for the PUAs because the PUA should have just been part of your savings.
How about I say two things? A, inside the policy is already an asset. So the money that you're depositing and borrowing, you're still making 1%. And the money that you're paying off that third-party debt, you're making 18 to 21% there. So I just broke it down two different ways. It's always a win-win.
He came back and said holding off on back loans. So is that loans that were in that the policy had prior to paying off the credit card debt and then recapturing the credit card debt? Because if that's the case, that would be a good way to do it, because you don't really have to hold off on paying the back loans, because if you're recapturing money from the credit card, chances are, or the debt, chances are interest rates are going to be much higher than what the insurance company charges you. So ineffectively, the full recapture is going to help pay off all loans over time. I think. I mean, it's a bit tricky the way it's worded. I think I understand it, but could be getting it wrong.
MRC, thanks for the question. I mean, one thing I would offer just someone, I'm newer in this group as far as using infinite banking, teaching infinite banking. Like, Chris has been around for 10 plus years. Hannah grew up in this, right? So we have, we 2 second generation folks here. I would say that just give yourself permission to say, hey, I don't know this yet, right? When you're because I just literally paid off all third-party debts other than my mortgage, recaptured $2,200 a month, and then had someone come up to my house yesterday and say, hey, your whole house needs repiped. It's only 5 years old, but they really put in crappy pipes, and that's $16,000. I'm like, damn, all my cash flow just went out to pay off all of my third-party debt, but life throws you new curveballs. Like, how should you best use the money? That's always going to happen. Like, anyone who thinks this is perfect and neat and tidy and you can figure it out in a spreadsheet, you ain't gonna. Like, I just know you're not gonna. It's gonna change. Like, things are gonna change. Hannah likes that.
I do. I really like that comment because honestly, that's so my life. I'm very straight up with you on the phone. Like some people ask me, well, okay, Hannah, now that I went and I bought a car, I'm going to pay myself back 6% interest, these monthly payments, how do I pay that back? And you could be as disciplined with it as you want, or you could play the game that I do over here. I just look at my money and I say, okay, there's too much sitting in the bank. I'll send back 1,000 this month. I'll send back 5,000 next month. And then that's just what I do because I'm just always funneling it through the policies. It's not a precise linear thing that I'm doing, but that just may not be everybody's brain and how they operate,
Thank you, Hannah, for
totally different from that. I'm a lot more regimented. I know each loan and I do a note for everyone. So if I pay off a car, I do a note and I put it in a little clear thing and I put it in a 3-ring binder so that if I forget, I always go back and look. And I set up automatic bill pays just so that the amount that was going out is the amount that's coming back. I don't think there's a wrong way to do it. I think one way keeps you very disciplined and keeps you very much, staying focused to what it is you're doing. Hannah, I don't see any issue with the way you're doing it because you just live it. But I think for the average person, I certainly would never tell them to do it that way because then you know exactly what would happen. They wouldn't put any money back into their policy and then they'd be blaming you for why it doesn't work.
Yep.
Yeah, I talked to one of those guys yesterday, Chris. You helped him 3 years ago. He set up a quarterly policy, had plenty of money, bought a $161,000 boat, and then you let the policy lapse. And now we were talking, he has plenty of coverage on his body still with that policy lapse. And now we're getting his son started. And I said, hey, I would be remiss not saying that you didn't practice discipline. You practiced regret the first time because you couldn't hold off on that gratification, that instant gratification. So if you're going to teach us as legacy, then be around the campfire, learn what we're teaching you. Like, here's a quick story about this week. So Connor's going to a new camp, SeaWorld camp. It's pretty far from our house. You get there on time, go through the gates. And the first time you get there, you're like, where am I going? Where's the cones? Where am I parking? How do I check him in? Like, there's all this uncertainty and unknown. It's all good, but you don't know what's going to happen. Then I leave and I'm going out the inn and I'm going the wrong way and people are waving their arms at me. And I'm like, where the F am I going? Day 2, I know what I'm doing. I know a little bit better where I'm going, but I go in the wrong lane to go in. I go behind everyone paying to go into the park. And I'm there for like 30 minutes. When if I would have went to the right 2 lanes, I would have went right through with a little pink pass that fell off my car the day before. But I parked and I knew how to get out. And I had a lady yell at me because I was going the wrong way again. And I was like waving to her like, hey, I'm just leaving. Yeah, but you have to leave over there. Then today I knew how to do everything. I was a genius. I was a genius. But that's how banking works too. And that's how everything in your life works. It's all repetition. It's all going through what you don't know and then doing it till you know it.
Wait, Jason, where at?
What? SeaWorld.
Okay, wait, are you going to go to SeaWorld this weekend? Will you be there?
No, I will be at an all-weekend Taekwondo. I'll be close to SeaWorld. I will be literally less than a mile away from you, Hannah, if you're going to be there.
Okay. Let me tell you something. In Florida, I found a really cool package because it's somebody's birthday this weekend. I got 2 park passes for Aquatica because we were in the Bahamas, right? I went down those water slides and I forgot how fun it is to go down water slides. So I was like, all right, babe, you know what we're going to do this weekend? We're going to go down some water slides. So I was looking at those park passes, but they had a really cool deal. I got SeaWorld plus Aquatica plus all you can eat in the park plus the hotel. I'm going there on Friday, checking out on Monday. $800.
That's quite the steal. If you know, it's $50 just to park for the day, by the way, everyone. So that's quite the steal. No, we will be Connor and Patty are testing this weekend for Legacy Black Belts. So we'll be with about 5,000 other martial artists. I will be bowing to everybody all weekend because I learned yesterday anyone that's a high ranked, I must stop, I must salute them, I must bow, not shake their hands. Hello, sir. Hello, ma'am. Keep moving. So it's going to be, I will be doing a lot of hello sirs, hello ma'ams, and watching some pretty cool stuff happening. So
that's fun.
Okay. We'll get through some rapid fire. I know we won't get to everybody's today, but I wanted to bring up this comment and kind of preface what Shauna commented on. So FCAT was talking about North Carolina. They're there waiting to meet us in Raleigh. So that'll be August 4th and 5th. So anybody who's interested to see what's going on then, I highly recommend, joining Chris tonight, 6 p.m. Eastern. There's a link in the chat up on the screen if you want to copy and paste that. moneyschoolrei.com/PMC-preview. Great training that Chris is going to put on after this. So we're going to end on time. So he has 30 minutes to regroup. But I just wanted to preface that anybody who's interested in that event and learning more about it, or just learning something new, hop on this webinar, check it out, and then hopefully we'll see you in Raleigh. But with that being said, Peter has another question. Besides Mr. HELOC, does anyone else on the panel use a HELOC to help to try pay off mortgage sooner?
I do not.
Craig?
Yeah, Costello with Abbott. I was on my way until the bank strung me along for 7 days and many hours and said, "Oh, you've only been a 1099 for a year? We got to wait another year."
Yeah.
Well, however, I will say that the use of my HELOC is not to pay my mortgage off sooner. It's to create more cash flow.
Love it.
Now, that cash flow can pay the mortgage off, but I'm just using the equity as opposed to letting it sit there and putting it to work.
And by year five, you'll be debt free. It's all cash flowing. Ask Joe.
This is true. And then you can pay off your house 4 times.
And then you can deploy that again and pay it off again. So I think I've paid my house off.
Drive in circles, buy tractor trailers. You can do all this through your one pot system and infinite banking.
Yep. So I think it's been paid off 3 times and then not.
Okay. Brendan says, should I wait to pay off my credit cards and instead let my agent from the Money Multiplier show me how to implement my policy to pay them down? I'm scheduled with Alyssa for next Wednesday for the intro.
I mean, I say yeah, right? I mean,
I
if you
would
get
wait.
policies and
I would wait.
just wait.
Pay
use
your
the
minimum. Pay your minimum monthly. Don't pay any more because once that cash is spent, it's gone forever, Brendan. So great question.
It is.
I'd wait, see what it looks like, and take the plan. And then the plan's just a suggestion, but take action.
Oh, and Brendan also is asking, is it worth watching the webinar at 6 tonight, even if I'll not be ready to purchase real estate for a long time? I just want to learn. Absolutely. Absolutely worth it.
The best real estate's between your ears, man. So yes,
Yeah, I would.
you should be
so.
there.
I'm just reading all the questions just as we're going by.
Got a lot of questions there. You guys are awesome.
Wait, put up Peter's comment about your broke ass brother-in-law. I'm gonna use an acronym. What do you say, Babil?
Babble.
Like Babylon.
Babil.
You should just like babble.
That's Babil. Oh, it's your broke ass brother-in-law.
Deal.
I
Great.
love when Brent says
New
that.
Kesslerism. A new Kesslerism right there.
Yeah. I wait for it every time. I'm like, here it is.
or when he does his stupid marijuana joke, I'm like, Dad, stop.
Oh, yeah.
I don't know that one yet.
You gotta listen to his presentation more.
I don't think he did a recording. That's probably why.
Okay, we'll hit this last question. It's kind of like a couple-part question from Drew. Okay, he's asking if there's a cheaper option to get started with the trust thing. Is there a trust structure light version? I don't know if anybody has the answer to that.
There is if you're around the $40,000 federal tax liability. Yes, there is a smaller version that's using just the LLC and the business trust. You only get half of it, and then you would use the policy as the foundation.
With who? Who is that with?
Solomon.
Solomon as well?
Yeah, I created it with them last summer.
Okay. I didn't know that. Okay, I'll keep that in mind. I was thinking it was 100 or more.
That's for the full. That's for the LLC, both trust, and the foundation. We can do it now with just the LLC and the business trust.
Okay.
Joe, you're incredible, brother. Where do you come up with this stuff?
Yeah.
And the time.
Thanks, Drew, for the question. Now we all know.
Yeah,
Yeah.
I wrote
Also,
that down. Put that in your
people.
notebook. Write that down, everybody.
I like Ken's question because I always tell people, yes, just take the policy that you get. Don't wait. Don't put it off because you never know what's going to happen tomorrow and you're going to be uninsured. That was from Ken.
And we'll leave you all with this last thought from wise old Shauna, wise young Shauna, I should say. She said, evolve with us. We are all learning a new opportunity every day, year after year. It's been great.
Mm-hmm.
Love
So
it, love
true.
it. Yeah, that is really good. All right. Well,
on the bear.
I will see a whole bunch of you at 6 p.m. tonight where we're going to talk about how someone else is going to pay for your car, your boat, your mortgage, and or yours or your kids' college tuitions. Because why should you have to pay all those bills when somebody else will gladly pay them for you? So we'll see you tonight at 6 p.m. Until then, thanks for joining us for another edition or episode or session of Ask Me Anything. And I would hold off on the Modelo mango chili. It's not good.
Try the